Welcome back to Economic Briefing. Today we break down how central banks quietly shape the economy, influence your money, and impact your daily life. Central banks are part of the government, but they are designed to act independently. They manage monetary policy, setting interest rates and controlling the money supply to keep inflation in check. Governments handle fiscal policy. That means collecting taxes and deciding how public money is spent. In short, central banks control the price of money, governments control its flow. The European Central Bank's primary mandate is to keep prices stable and inflation in check. The Federal Reserve has a dual mandate: price stability and maximum employment, a balancing act that is often challenging. Most central banks target low inflation, around 2%, not zero, because low, steady inflation supports growth without eroding purchasing power too much. But even modest inflation adds up over time. At 2% a year, $100 shrink to just 82 in 10 years. At 5%, it drops to 61. At 10%, only $39 are left. Central banks influence inflation by setting interest rates. The cost of borrowing money. When they raise rates, borrowing becomes more expensive. This cools down spending and investment, slowing the economy and help keep inflation in check. When they cut rates, borrowing gets cheaper. This encourages businesses to invest and consumers to spend, stimulating economic growth. The central bank policy rate is the benchmark interest rate set by the central bank. It is what commercial banks pay to borrow money from the central bank or from other banks. Because this is a short-term rate, central banks mainly influence the short end of the yield curve. Long-term interest rates are shaped by market expectations. The yield curve shows interest rates of government bonds over different time periods, from short-term to long-term. Under normal conditions, longer-term bonds have higher yields than short-term ones, reflecting greater risk over time. But when short-term rates rise above long-term ones, the curve inverts, a signal that investors expect economic trouble ahead. Often seen as a warning sign of a recession, an inverse yield curve means that investors see more risk in the short term than in the long term. But here is what matters. When the policy rate changes, it affects the entire financial system, from mortgage rates to credit cards to saving accounts. So whether you're buying a house, paying off debt, or planning for retirement, central bank decisions directly shape your financial reality. They don't just set the base rate, they influence the entire structure of the interest rates across the economy. Aside from keeping prices stable, central banks also issue currency, manage foreign exchange reserves, regulate banks, and do economic research. A central bank also acts as the lender of last resort, stepping in during a financial crisis to provide emergency funding when banks or institutions can't borrow anywhere else. By supplying liquidity, it prevents collapse, restores confidence, and helps stop bank runs before they spread panic across the market. Central banks might not make daily headlines, but their decisions shape the economy and your financial future. If you found this helpful, don't forget to like, subscribe, and share. Thanks for watching.